You've got Dr. Birx, okay, on the task force. The COVID surge, she says, quote, the worst event this country will face coming this winter. Stocks have run a lot into November. The vaccine's getting closer day by day. Value's been outperforming lately. In fact, the value ETF is coming off its 5th positive week in a row. That's the first time since its 5-week stretch ending the end of December of 2019. So my question to you to start things off, where do we go from here?
I mean, it seems like the market wants to go higher. I mean, I think it's been incredible all year. It seems to definitely be picking up steam in November and the first part of December, is that investors are leapfrogging past the litany of things, Scott, that you just highlighted: the slowing economy, the increasing cases, the political discord in Washington, the lack of fiscal stimulus, and leapfrogging over that and buying stocks in general. They're buying growth stocks, they're buying momentum stocks, are buying value stocks, airlines, energy, all of the above. And so I think it's a really good time to reflect is, as investors, you got to be in it to win it. And I feel that by the time, the vaccine's actually here, disseminated, and we get behind this, who knows where the S&P will be, but it seems like it's going to be, quite a bit higher than where it is today.
Okay, Weiss, so you take that on. Bryn says the market wants to go higher. Does it want to go higher, or does it want to pause? Morgan Stanley's Mike Wilson, frequent guest on this program, says, quote, recoveries create rotations, but with those rotations now fully in gear, it may be time for a near-term pause.
Anytime market has moved, this market's had, you wouldn't be surprised at a pause. However, the catalysts will keep coming. The way I look at it is, yes, the market has taken some of what's in front of us in terms of the recovery and put it and embedded it in where the performance has been. However, if you look at where the market was before COVID, the beginning of the year, we're not that much higher. But what's changed? What's changed is massive economic stimulus around the world that's going to drive an economic recovery that's synchronized globally. So under that score, as well as the potential for greater stimulus here for an infrastructure plan and for massive CapEx, which I keep harping on, we'll see the biggest CapEx cycle this country has ever seen, would say that the market's got a lot of runway ahead of it, and I think that's going to dictate the direction.
Yeah. Brenda, I think it's an interesting debate to have, and you're starting to get some notes on the street now as to what's already baked in. I mean, the market went up a lot in November, like Steve was saying. Lori Calvasina of RBC says their analysis suggests that the recovery has room to run from a fundamental perspective. I think everybody would agree with that. But she says it also suggests that a key risk for equities in 2021 is that the recovery is mostly baked in already. Do you agree with that?
I think you could say that about certain sectors. So if we look at large cap technology, obviously it started leading this recovery that we've seen, but it actually didn't keep up with the broader market as a group in November or for the quarter to date period, even though it's had a positive return. So I think what we could see and what we have absolutely seen is a catching up of other groups. And that's small cap is a great example. So just for this current quarter to date period, since October 1st, small cap is up 25%, which is phenomenal. But it's been a huge catch up. But still, if you look over a longer period of time, over 3 years, for example, the cumulative returns in small cap are still only about half of that of large cap. So there are other areas where I think there does continue to be an opportunity. We've been adding to more value-oriented groups and sectors. Just as part of our thesis that when we look at these more beaten up cyclical groups, they're really going to be able to grow earnings exponentially in 2021, most likely, or the second half at least, and then 2022. And that historically has led to outperformance of those groups. So we think there continues to be opportunity, but I think it pays to be mindful of what has worked thus far and what might work as we look out over a longer period of time.
So, Joe, I think one of the most obvious questions that any investor would have, I think we're all wondering this ourselves. Are you going to have a melt up into the end of the year? Is that likely? Do you get the Santa Claus rally, which isn't, by the way, just until the end of the year? Traditionally, it is into the first week or so into a new year, or because you've maybe pulled some forward from the November record run in stocks, do you miss out on this year's melt up?
Great question. I think the answer to that can be found in where the 10-year Treasury is going to be priced. Because I think, Scott, to Stephen's point, a lot of the gains have been pulled forward on the expectation that you're going to get a $908 billion stimulus package, on the expectation that not only do you have the introduction of 3 vaccines, but potentially on Thursday, the FDA approves the Pfizer vaccine for emergency usage. I think a lot of that is priced into the market. Where we go from here is predicated on capital coming out of where it's been hiding, which has been the fixed income market being delivered into the equity market. That propels it higher. Let's cite that today, once again, the NASDAQ is higher. 9 consecutive days. That's the best performance since last year. So I understand the fascination with value. I get it. But overall, we're not losing exposure to that defensive, technology, growth-oriented holding in the portfolio.
Let me ask you.